how to start trading with a smaller account. So we asked the research team to put together something a little different for today. Unfortunately, we have no Chris Vecchio today because he's on the road for the holidays. So we got three pieces of research today. So as we enter the new year and more traders start to enter the market, it's important to look at how to start trading with a smaller account. A lot of people ask us how to get started. We have all these different videos. I did one with my daughter Case. Tony did one with his son Nick, not to mention hundreds of others called Where Do I Start?
Yep.
But we've been doing stuff over the years to get people started in this business, and it's just an insane amount of content. We've probably created more options content than, I'm going to go on a limb here and say we've created more option content than everybody else in the world combined over the last 14 years. Because we basically created, over somewhere between 10 and 14 hours a day for 14 straight years. I don't think anybody's even close. So with the markets trading at all-time highs, it may be easy to overlook the scope of stock market growth over the last few years. In fact, over the last 5 years, the S&P has almost doubled. The NASDAQ has more than doubled. The Russell has increased by about 800 points. Market's going up a lot.
Sure.
Let's go to the next slide. So as asset prices rise, new traders find themselves more capital constrained than when they first started out, because capital requirements to trade options increase proportionally to asset prices. That's one of the parts of this business. I mean, as the market goes higher, things get a little bit more expensive to do because everything's based on a percentage of notional value. So unless the stock splits, bringing its prices lower, we need to find underlyings and strategies to trade and keep capital requirements low and the probability of profit high. So, what we found, and we put some fun stuff up here, in December of 2019, the Qs were 211. Now they're 531. Meta, which is Facebook, of course, was 200. It's 600. Netflix was 300 and change. It's 900. Even McDonald's, it was 200. It's 300. Just showing you some of the growth over the last 5 years has been insane.
Right, and you mentioned McDonald's there just because it's a multi-$100 billion company that usually is not like a growth stock. It's more of like a dividend paying, slow and steady type stock. Even that stock's up 30% or whatever.
We're going to go to the next slide. So simply adding long wings to like a short strangle, for example, might not be the only answer. Even though we still have access to defined risk trades, be aware that a fixed width spread or an iron condor in an underlying that increased significantly in price sees its probability of profit greatly reduced. So what do? So in order to get the same pop that you had in 2019, your wings on a 20 delta, for example, IWM iron condor, need to be $20 wide, making it much less feasible for smaller accounts, partially due to the added skew. All that means is, given how much the market's rallied up, you have to get kind of wide to get the same amount of credit. You have to get kind of wide to get the same probability of profit. We put it up here just so you can see with pop. In 2019, a IWM iron condor in December had a 69% pop. And if we did the same iron condor 5 years later, it's 61%. Okay, that's a 15% reduction in probability of profit for the same exact trade. So let's go forward. It's a cool study these guys did.
Yeah, they did. Yeah.
So to answer the dilemma, it's actually not as complex as it seems, due to the beauty of product indifference. Tasty is all about product indifference. It's like we're agnostic to product. We don't care if it's an ETF, if it's an equity. We don't care what it is. It could be a futures option, doesn't matter. So in other words, as long as the product you find is liquid, that's the key, liquidity. It has a tight bid-ask spread. The name of the company doesn't matter so much when it comes to the risk reward of the trade. So we looked at some assets below that have relatively high implied volatility and a high IV rank, and they're liquid with almost 4 stars, 3.5 to 4 stars. They're reasonably priced, and the iron condors or even strangles may be doable for traders with smaller accounts. So just to show you, we put up here a couple of names like FXI, the Chinese ETF, EWZ, the Brazilian ETF, GDX, a gold mining ETF, and SLV. These are all inexpensive stocks. Not my favorite as far as liquidity goes, but we have positions on in GDX and FXI right now. But so we do trade them. And you can see for strangles, capital required is a very small amount of money on a relative basis. $500, $300, $500, $400. So they're doable for most account sizes. Let's go to the next slide. Small accounts tend to be capital constrained from doing undefined risk trades, which is why tasty traders often opt for defined risk trades. How can we strategically choose undefined risk strategies like strangles and short puts or short calls, whatever, so they would be available to smaller accounts, maintaining the benefits of the undefined risk trades? And obviously, this has a lot to do with implied volatility. So next slide, Beth. For both low and high IV underlines, using a defined risk strategy will cost between 20 and 40% of the credit received, depending on implied volatility. So we gave an example here of two stocks, Delta Airlines and CMG. We're trying to go all over the place with this. Delta with a high IV, CMG with a low IV. And we showed you kind of just the difference in, because they're both about the same price, $61 or $62. So you got a lot more credit with Delta because you got a much bigger credit on a one standard deviation strangle. You got a much bigger credit on a one standard deviation iron condor because it had higher implied volatility. And so you end up with just, more credit. We're just kind of
the
giving
higher
examples.
Implied volatility you're saying, right?
Yeah, just due to higher implied volatility.
Yeah, same delta, nothing.
Same delta, same price.
Stock. Right.
Yep.
Right.
Same delta, same price, twice as much money.
Right.
Okay, let's go to the next slide. So when using undefined risk trades in low implied volatility stocks, you get a sizable increase in buying power required. However, in high implied volatility stocks, the percentage increase in buying power is much less, allowing you to use more undefined risk trades. So we gave another example here. This is using the same two stocks. This time we looked at a strangle versus an iron condor, and it's Delta and CMG again. And you can see the iron condor is going to use the same amount of money, but the difference here is the one standard deviation strangle and the percent change in buying power. Just you're using more buying power is the point. So these are buying power reductions. This is not credit received, buying power. So the strangle in CMG requires more money because the credit you receive is less. The strangle in the percent change is 58 compared to 36 in CMG. So you use a lot more money because of the low implied volatility. Whereas when you do an iron condor, it's going to be the same.
Sure. Iron condor is never going to change because it's defined risk.
Let's go to the next slide.
You know what? You will receive a little bit more credit on the higher implied volatility of an iron condor.
Yeah, that's why the requirement's lower.
Right.
So some of the takeaways: many popular assets have more than doubled in price over the last 5 years, increasing the difficulty for new traders with limited capital. So defined risk strategies cost 25 to 40% of the credit received. However, undefined risk in high IV stocks offers a better credit over buying power reduction ratio, and a smaller buying power reduction increases, making undefined risk trades more feasible for smaller accounts. And new traders should focus on product indifference, prioritizing high liquidity, moderate to high implied volatility, high pop, and low capital requirements over specific asset names. It's a pretty heavy study for an intro study, but I think it covers so much good stuff. It's really well done.